bankers judging that the only way they can try to pull down inflation is to carry on raising interest rates.
We're going to see rising rates.
Rising interest rates that will make the cost of borrowing go up.
You think inflation just raises prices. I mean, that's what you've been told. That's what the Fed says. That's what every news anchor mouths between commercial breaks. Inflation goes up, prices go up. The end. But I think we've been lied to about what inflation actually does. Because here's what almost nobody on the news is connecting. Your homeowner's insurance just went up 46% in 5 years, 3 times faster than inflation. Your property tax bill is up 3.7% in a year your home value actually dropped, outrunning inflation by 37%. And the equity you think you've built, measured against the dollar that's actually inside it, most homeowners are flat to down compared to 2021. 3 different bills, 1 mechanism behind them all. But hold on, if that happened on its own, in one place, maybe you could write it off. But it's been happening in 3 places at the same time, hitting the same homeowner in the same year: equity, taxes, insurance. And there's a theory that says when a single mechanism causes 3 different bills to hit you at once, that's not bad luck. That's a system. Look at it like this. Picture your home as a bucket. The water inside it is the wealth you've spent 20, 30, 40 years putting in there. The equity, the protection from inflation, the safe place for your money to live. At least it always has been. The bucket, it looks fine on Zillow, looks fine on your last appraisal, looks fine when your neighbor sold last summer for a number that made your jaw drop. But while you weren't looking, inflation walked up to your bucket and drilled 3 holes in it. 1 at the bottom for the equity that's quietly evaporating against the dollar, 1 on the side for the taxes the county is siphoning out every year, and 1 on the other side for the insurance and repairs eating away at it every month. Then it welded the lid shut so you can't pour what's left into a different bucket. And the lid is so tight, homeowners are sacrificing things you'd never expect just to keep it sealed. 22% of homeowners said they'd delay retirement 5 or more years to keep their current mortgage rate. 6% of American homeowners said they'd skip or delay medical care just to keep their rate. People are restructuring their lives, their marriages, their bodies around an interest rate. That's not a housing market. That's a hostage situation. And the system that created it is the same system telling you that inflation has cooled. So in the next few minutes, I'm going to show you exactly how inflation drilled each of those 3 holes. The mechanism, in plain English, not Fed jargon. I'm going to show you who locked the lid on top and why they did it. And I'm going to give you 3 moves you can make this week to slow the bleeding. At the end of all of this, I'm going to show you the part nobody is saying out loud. That the same inflation draining your bucket is filling someone else's on the other side of town. By design. So let's begin addressing what you've been told inflation is, because if you don't understand what it actually is, nothing else here will make sense. Inflation isn't prices going up. That's the lie. Prices going up, that's the symptom. Inflation is what causes those prices to go up. Prices go up when you've got too much money chasing too few goods. That's it. That's inflation. That's the whole shebang. It's like this. Imagine a teacher has 1 candy bar sitting on her desk. There's 1 student in the room. The teacher says the candy bar costs $1. The student gives her $1 for it. She gives him the candy bar. Simple. The candy bar costs $1 because there's only 1 buyer and 1 candy bar. Now let's run it again. Same teacher, same classroom, same candy bar. But this time, 10 students walk into the room. The teacher says, "Who wants to buy this candy bar for $1? All 10 students raise their hands. Now the teacher has a problem. She only has 1 candy bar. So she says, okay, I can't sell 1 candy bar to 10 people, so I'm gonna sell it to whoever is willing to pay the most. 1 kid says, I'll pay $2. Another kid says, I'll pay $3. Another says, I'll pay $5. And another says, I'll pay $10. Now the candy bar sells for $10. But wait, did the candy bar change? Is it bigger? Is it better? Higher quality chocolate? No, same candy bar, same size, same chocolate, same wrapper. The only thing that changed was the number of dollars competing to buy it. That's inflation. Inflation is when more money shows up, but the amount of real stuff doesn't show up with it. Inflation isn't the candy bar getting more valuable, it's the dollar becoming less valuable. Too much money and too few goods. Now, there are 2 engines that cause this. Engine number 1, you've likely heard of referred to as money printing. When the government prints dollars, either through stimulus, deficit spending, the Fed flooding the banking system, Every existing dollar in your wallet buys a little bit less candy bar. Same number of dollars, less buying power. You become a little poorer just sitting there, yet you did nothing to cause it. Now let's run it one more time and I'll show you the second engine. 10 students again. But this time, the candy machine across town shut down. So instead of one candy bar on the teacher's desk, there's only half of one. Same 10 students, same dollars, half the candy. Now what do the students pay? $20, maybe more. Less candy to go around. That's the second engine, supply chain disruption. When something breaks in the real world supply of goods, a pandemic shutting down ports, a war disrupting energy, tariffs hitting building materials, there are fewer goods available. Engine number one was more money showing up. Engine number two is less stuff showing up. When both happen at the same time, the price doesn't just rise, it explodes. And that's exactly what happened to your house from 2020 through 24. Both engines firing at once. And the place that damage shows up biggest in most Americans' lives isn't the grocery store or the gas pump, it's the four walls you live in. So here's the actual number. This is the M2 money supply. The total amount of dollars sitting out in the US economy was $15.4 trillion in February of 2020. By April of 2022, it hit $21.7 trillion. That's a 41% expansion in 2 years. So for perspective, it took 17 years before that, from 2003 to 2020, to double from 6 trillion to 15. They added another 6 trillion in 24 months. So what happened? Massive amount of money chasing a small number of candy bars. Real estate boomed, stock market soared, crypto took off like a rocket, and groceries? Forget about it. You were there, you know. All right, now you know what inflation is and how it works. So let me show you where it's living right now. Because inflation didn't just visit your house. No, it moved in. It's standing in your kitchen. And it's pulling things off your shelves while we're having this conversation. Starting with the first hole, the one at the bottom of the bucket. Your Zillow estimate says your house is worth more than what you paid for it. So your equity grew, right? No, not necessarily. Here's what I mean. When the government printed 41% more dollars in 2 years, every dollar in your bucket became a little weaker. Same number of dollars, less actual value. That's the leak at the bottom, and it's been draining since 2020. In 2025, the average single-family home value actually dropped 1.7% to $494,000. ATTOM data, April 2026. First annual nominal decline in years. But here's where it gets worse. Zillow projects only a 0.3% home value increase for this year, against today's inflation rate running currently at 3.3%, the highest reading in 2 years. You're going backwards in your home equity at a rate of 3% in real terms. And it's about to get worse. The OECD, that's the Organization for Economic Cooperation and Development, basically the international think tank that 38 of the world's wealthiest countries use to model economic forecasts. Well, they just revised its US inflation forecast for 2026 up to 4.2%. Goldman Sachs has scenarios running as high as 4.9% if the war drags through summer. Every expert and entity that wants to chime in is revising their projections aggressively upward because they all know what's coming. A lot fewer candy bars on the shelf. And here's why. The ingredient required for that candy bar machine to run, as well as what it took to manufacture the candy bar and what it took to deliver the candy bar to the machine, is oil. And it doesn't stop at candy bars. Petroleum is the input to roughly 6,000 everyday products: plastics, fabrics, fertilizers, asphalt, packaging, pharmaceuticals. And nearly 70% of all US petroleum consumption goes to transportation alone, which means even the products that don't contain oil still depend on oil to reach you. So when the Strait of Hormuz closed in February of 2026 and Brent crude shot from $70 a barrel to $118, that wasn't one candy machine breaking down. That was every machine in town suddenly costing more to fill, run, and deliver. Now, I'm no economist, but the math, it doesn't add up when the official inflation number says we're up 24% over the last 5 years, and a Big Mac is up 32%. A grande latte at Starbucks is up 40%. Your auto insurance is up over 50%, all of them over the same exact period. You see, things you buy every day are up 32 to over 50%. The number they read on the news is 24%. It's like half. Which means whatever Goldman Sachs is telling you about 4% inflation this year, whatever the OECD is forecasting at 4.2%, that's the floor. That's not the ceiling. Because the official number has been understating the pain at the cash register for years. The number on the news isn't the number on your receipt, and the dollars sitting inside your home equity are covering the gap. In the macro picture, total U.S. home equity hit a record $17.8 trillion in the third quarter of 2025. ICE mortgage technology data. Looks like the biggest pile of homeowner wealth in history. Well, those dollars are significantly weaker than they were in 2020 after years of high inflation. So the pile looks bigger, the wealth inside it is not. A bucket that's held water reliably for generations has been quietly leaking the last 5 years. Because for the first time in modern American history, inflation is stronger than the bucket. And that's just the bottom. Now let's talk about the side. Hole number 2. This is the meanest mechanism in the whole bucket. Most homeowners assume property taxes track property values. The value goes up, taxes go up. Value goes down, taxes go down. That's the old model though, built for an era when most counties only reassessed your property when it's sold. Well, that era is over. Here's what actually happened. Inflation didn't just hit your grocery bill. It hit your county's budget too. Teacher salaries, pension obligations, asphalt, diesel for the fire trucks, insurance for the police department. Every single line item in your county's budget got hammered by the same inflation that's draining your equity. Inflation doesn't discriminate. It don't care. And the county doesn't get to opt out. So they need more revenue, and they need it fast. And the fastest way to get more revenue without passing a politically dangerous new tax law, reassess your property, raise the bill. But it gets worse. You see, most counties used to assess property at the last transaction price, meaning your tax bill stayed roughly stable until you actually sold. When inflation started squeezing local government budgets, counties shifted to annual or biennial reassessments to keep up. The pandemic-era price spike, the one that's now reversing, got baked into your assessment. The bubble may be on the verge of popping in the market, but your tax bill isn't as vulnerable. The average single-family property tax bill in 2025 was $4,427, up 3.7% year over year. CPI for the same period, 2.7. Your tax bill ran 37% faster than inflation. Rob Barber, the CEO of Adam, confirms by saying it out loud, property taxes often rise faster than inflation because they're driven by local government funding needs, not consumer prices. Translation, when the county's costs go up, your assessment goes up, whether your home is worth more or not. The county doesn't care what Zillow says. The county cares what their pension fund says. Between 2019 and 2024, property taxes rose 30% nationwide. That's the Institute on Taxation and Economic Policy, outpacing both wage growth and general inflation. And that's the second hole, the side puncture. Inflation hit the county hit you, and you've been mailing them a check for it every 6 months without flinching. And they get away with it because only 5% of homeowners ever challenge their assessment, even though 40 to 60% of those appeals succeed. If you need help with that, I set up a page for you at fightmyassessment.com. So inflation is draining your equity from the bottom and your tax bill from the side. And right now, while we're talking, there's a third hole still picking your pocket through the most innocent looking envelope in your mailbox. Hole number 3, your homeowner's insurance. It went up 46% in the last 5 years. Not because of your claims, not because of your roof, not because you forgot to trim the tree branches over your shingles. Your premium went up because the candy bar costs more to manufacture, to store, and to ship. And the nation has a massive sweet tooth. Here's what I mean. The insurance company's job is to estimate what it would cost to rebuild your house if it burned down to the ground or got flattened by a storm. That number is called replacement cost. Replacement cost is built from lumber, copper, drywall, shingles, and labor. Every single one of those inputs got hammered by inflation, especially the supply side engine. Lumber's up, copper's up, drywall's up, skilled labor is up. Tariffs on imported building materials adding another layer of pressure on top. So the insurance company recalculates your replacement cost. It went up, so your premium goes up. The insurance company isn't betting you'll have a claim. They're betting that if you do, the rebuild will cost more dollars, and inflation guarantees it will. That's the mechanism. And here's how that's hitting the actual bill. Insurify projects the average homeowner's insurance premium hits $3,057 by the end of 2026. That's a 4% jump on top of last year's 12% jump. Premiums are up 46% since 2021, roughly 3 times the rate of inflation over the same window. Insurance now accounts for 9% of the typical homeowner's monthly mortgage payment. Maddox, December 2025 data. That's the highest share ever recorded. Ever. On a $3,000 mortgage payment, that's $270 a month going to a bill that didn't even exist as a serious line item 10 years ago. And it's not just your insurance. The same mechanism, different bill. Lumber's up, labor's up, tariffs are up. Every repair you'll ever need on this house is now hit by inflation. Average annual home maintenance is $8,808. Bankrate's 2025 hidden cost study, up 42% in 5 years. Half of homeowners say there are necessary repairs they need right now but simply can't afford. Half. Not feeling fancy about it, they need it. And that's the third hole. Inflation is in your insurance. Inflation is in your repair quotes. Inflation is in the cost of keeping the lights on, the roof watertight, and the HVAC running. The bucket isn't just losing water from the bottom and the side anymore. It's actually evaporating from the top too. I mean, you might be thinking the obvious play is to sell and run, cash out, downsize, move somewhere cheaper, take what's left of the equity and rebuild somewhere with a smaller tax bill and a friendly insurance market. Here's the part that's really terrifying. You can't, because selling means giving up your sub 3% mortgage and walking right into a 6 1/4. Your payment doesn't tick up, it doubles. So you stay. You keep paying the taxes. You keep paying the insurance. You watch the holes get bigger. And the math is so brutal that 1 in 5 homeowners would rather delay retirement 5 years than give up their rate. That's not a hypothetical. That's a survey from January. That's the lid on the bucket and it's welded shut. And the question isn't whether this is real. I mean, you can pull up your assessment notice, your insurance renewal, and your mortgage statement right now and verify every word of it. The question is, what do you actually do about it this week? Because doing nothing means watching the bucket drain while the rest of the country tells you everything is fine. So here's 3 moves. Active defense. None of them are the full solution, and we'll get to that one in a second, but every one of them stops a different leak. Move number 1. Audit your property tax assessment. And this is a pain, I get it, but 5% of homeowners challenge their assessment. That's it, just 5%. But 40 to 60% of those appeals actually succeed. That math, it's screaming at you. Pull your most recent assessment notice off the kitchen counter or the filing cabinet or wherever you stuffed it last spring and compare your assessed value to what comparable homes in your neighborhood actually are selling for in the last 12 months. If your assessed value is meaningfully higher than recent comps, you have grounds to appeal. The county isn't gonna volunteer the discount. You gotta ask. I've put together a resource for you at fightmyassessment.com that walks you through exactly how to pull your comps, file the appeal, and present the case. Most counties have a 30 to 60-day window to file once the assessment hits your mailbox, so don't miss it. Move number 2, audit your insurance coverage and your deductible. Most homeowners haven't reshopped their insurance policy in 3 or 4 years. Your premium went up 46%. It's time. Your dwelling coverage probably went up too, automatically, without you ever signing off on it. Pull your declarations page. Check what your current dwelling coverage is. Then check what it would actually cost to rebuild your house. There's a fair chance you're either overinsured on a number that doesn't match reality or paying for a premium tier that has cheaper alternatives in the market. Either way, the number on that envelope, it isn't fixed. Move number 3, pull your mortgage statement and run the real equity math. This is the one that hurts the most. Take your home's current Zillow estimate. Subtract the price you paid for it. That's your nominal gain. Now subtract inflation over the years you've owned it. The Bureau of Labor Statistics has a CPI calculator online. It takes 30 seconds. The real number on your equity is almost certainly smaller than the nominal number. For a lot of homeowners, depending on when they bought, it's near 0 in real terms. And once you see it, you understand exactly why 3 holes and a locked lid is a bigger story than your renewal notice was telling you. So 3 moves. Let's do some damage control. Let's preserve some solvency. Now look, I just spent the last 15 minutes beating up your house. Little depressing. Drilling holes in your bucket, I get it. Showing you how inflation is eating your equity. Your taxes are outrunning your value and your insurance is bleeding you dry. Like, Matt, I get it, please stop. Well, all of that is true, but here's what's also true. Despite every hole I just showed you, despite the locked lid, the eroding dollar, the county siphoning your wealth, owning a home is still really one of the best purchases an American can make. And the data backs it up. So the National Association of Realtors just did their own version of the study, and they found it to be 43 times. Not 4 times, not 14 times, 43 times. Now, before you start shouting saying that study is biased, I get it. But the Federal Reserve did the same study just a few years ago, and they found a very similar number. They found 44 times. Homeowners average $430,000 in net worth. Renters, $10,000. And so yeah, homeowners have been hit hard by inflation, but renters, they got hit harder. And why were they hit harder? Well, because renters are paying rising rents with no equity to show for it. They're going deeper into debt just to cover basic living expenses. Homeowners, on the other hand, even the ones getting squeezed by taxes and insurance, are still sitting on an asset that over time tends to appreciate faster than inflation. Not every year, not in every market, but over the long haul, home appreciation edges out inflation. It ebbs and flows. It's a timing issue, but historically it does win. So if you own a home right now, even with the 3 holes in the welded lid, you're still playing the right game. The bucket's leaking, but you still have a bucket, and that still matters. That said, the damage is real. Inflation is hitting homeowners so hard right now you'd think the system is broken. But the system, it's not. It's doing exactly what it was designed to do. You see, the thing about inflation is that where there are losers, there are also winners. See, money, it doesn't disappear, it just moves. The water draining your bucket is filling someone else's. The same Fed policy that locked you in unlocked something else for them. The same supply cost inflation that's hammering your insurance premium is paying their bottom line. The same tax mechanism that punishes you when your county needs revenue, it rewards them with deductions you don't get. You see, while your home is losing real value to inflation, there's another kind of real estate that's gaining value because of it. And that's why I pulled this video out here for you to watch next. It's not an accident that they're winning while you're losing. It was designed that way. It's a game with 2 sets of rules: the way the masses play and lose, and the way the few play and win. Watch this. God loves you, and so do I. Take care.